Investors and traders, welcome to the channel. Today is 6th of October 2024. Hope everyone is having a great weekend. We will be taking a look at the key US stock indices and markets in this video segment. In fact, we will also be taking a look at some of the global markets. We'll briefly take a look at the Chinese market and the Hang Seng from Hong Kong, and then some of the European markets such as German DAX and the FTSE 100. As always, this video is for educational purposes only. It's not a financial advice. We are taking a look at the chart of our timing model. This model has made some fantastic calls with turns in the market, so this is why we should pay attention to it. And we have some minor dates coming up. 7th of October, which is going to be the next Monday, we have a minor date coming up, and then the following Monday we have another date coming up on the 14th of October, and then we have the key date, which is coming up on the 7th of November 2024, which is a few days after the elections in the United States, I believe. And as always, with these timing dates, we have to give it 2 to 3 trading days on either side. And a really interesting thing about talking about the elections in the United States, I was sent a couple of charts which I thought I'll share with you because they have some really interesting statistics. So here's a chart coming from the source Kali Bost. I believe it's a Twitter account now known as X. And what they have done is basically plotted the S&P 500 average monthly return since 1950. And the blue ones is all other years, and the yellow ones are election years. So if we just focus on the election years, what we can see is the month of October is actually lost about spot 8%. So minus 0.8%. So less than 1% is the kind of average return for the election years. And also the month of September, according to this statistic, is down by about half a percent. Of course, these things can change because something which is a little bit unique about this cycle in terms of the election cycle is that the Federal Reserve has actually started or embarked on their journey to cut interest rates. So they have actually pivoted on their policy of tightening, and they have started with actually a not even a quarter basis point, but half a 550 basis point, which is half a percentage point. So that's really interesting. So I'm not sure whether this statistics actually capture this unique scenario, and I'm not even sure whether we have had a situation where before the election taking place, the Federal Reserve has actually embarked on their interest rate cutting cycle, and with a bigger than expected interest rate cut. So I should say bigger than a quarter point, which is kind of the normal for a starter. Now that's interesting. I think when I get some time, I'll try to do my own research and come up with the statistics, and then I'll share it with you guys. Another really interesting chart, which is worth sharing with you guys. This comes from the source Nordia and Macro Bond. I was posted on Twitter, 15th of November 2020, so it's a little bit old. But what they have done is actually quite interesting, because they have gone and looked at the average S&P 500 performance around U.S. Presidential elections since 1972. And they have excluded 2008 because of the financial crisis going on. So, maybe that was an anomaly, so they have taken it out to smooth their data. And here what we can see is this is on the left hand side, we have got days before the election and days after the election. So it's really interesting where this line is. This is when the election took place. We can see there is a dip coming up in the S&P 500 based on this statistical study they have done. So it's coming up to about 6 days, 6 trading days, I would imagine. So that's about a week and a half. So that's an interesting one to take a look at. And if you look at just before the election, so if we just go back maybe a week and a half or minus 6 trading days, there is actually some sort of a resumption or some sort of a rally coming in. But if you go back a month before the elections, you can see that it's just a the market just goes nowhere. It just trades range bound and quite frustrating price action by the looks of it. So interesting statistics I thought I'll just share with you guys. Now, let's start by taking a look at, let's actually take a look at the Bitcoin, because I did not cover that in my video that I've done before. And let's move on to the weekly chart on, in fact, let's take a look at the monthly chart on Bitcoin. And here we go. So you can see that the Bitcoins had made these stops here, and this stop came in March of 2024. And if you look our video at our video of Lucas timing cycle, this is when a key timing cycle was coming in. Now the next key timing from my perspective came in September, and the month of September actually closed positive. That's a pretty good thing for the Bitcoin now, as long as it doesn't really close below this 50,000 38.2% retracement. I think it might just be remaining more of a trading range behavior, but eventually the chances will come that we might have actually seen a pretty good bottom come in, and then it might actually begin its bull run again. But again, the key date from the next key date from my perspective comes in March of 2025. So there's a possibility we might still remain range bound for a few more months. That possibility is there. And then on the daily chart, just going back here, what we can see is here it just got above this zone we were speaking about. And I don't know in terms of retracement what sort of retracement it did actually. Let's do a quick retracement on this one, and yeah, 78.6% retracement, which is actually, this move is pretty strong, because this shows there is strength in the market. This is the bottom of the range, and was actually able to retrace this much, which in my opinion actually has weakened the down thrust. Because if this market was really strongly trending, then 38.2% or even 50% retracement and then moving lower from there would have indicated stronger momentum to the downside. But this one is actually a range bound market, pretty frustrating market if you were trading it. But if you're trading intraday, I think Bitcoin provides lots of opportunities. I don't trade this thing. But price action is just like any other commodity we take a look at. Now, let's take a look at the Chinese market. So we'll start by taking a look at FXI. Before we do that, actually, some really interesting point to raise is that last Friday we had the non-farm payroll data come out, and we also had the unemployment rate come out. Now with the non-farm, it was a stronger than expected figure. You can see that 254,000 jobs creation. But one of the things with I don't know, in my opinion, is that I don't think it really means much now, the kind of data non-farm payroll, the kind of importance it used to have, because I think they had come back and actually revised last year's data by about 800,000 jobs or something to the downside. So even the Federal Reserve chairman in his last meeting mentioned that, okay, they will look at they pay attention to this data, but they're also going to actually use some of their own caution towards it, and I think they'll actually revise the jobs downward themselves. I don't know what sort of algorithm they're going to use for it, but I think there's not too much usefulness in this point in this data anymore from my perspective. But what is really important is this one, which is the unemployment rate. And you can see that the unemployment rate has actually gone down by about 0.1%. So 0.1%, it just went down a little bit, which means that the job situation is strong in the United States, and the consumers are likely to be healthy spenders with the shopping or the holiday season coming up pretty soon. So this could actually have an impact on the inflation side of things. Now, what it means is that I'll just have a quick look at because we covered this in our video, which I did yesterday. So here we can see that here is the 2-year Treasury note. It just shot up. Look at this. This is really, really strong. Now, it shouldn't be too much of a surprise, because where the market had traded to, we were expecting support to come in, and this is exactly what has happened. And this move, we have seen this much move before as well. It's just that last Friday was really strong, and but in terms of the symmetry concept, it's still, you know, within those parameters, and the chances are it could actually go a little bit higher to about 4.1%. So that's an interesting observation with respect to the non-farm payroll data and the unemployment rate data that came out last Friday. Now let's take a look at the Chinese market, because the Chinese government, they had come up with a bazooka with the kind of stimulus they are doing for their property market. Of course, it's going to spill over into other assets as well. And stock market is a very liquid asset class. And here what we have seen is last week a continuation of the bullish move that we saw when the actual news broke out about the stimulus coming out. And the interesting thing is that it's broken above the 38.2% retracement. Now these past 2 weeks, the momentum, the moves have been really strong, and the moving averages, because they're lagging indicator, they're moving, and their averages, they are catching up with it. So eventually what will happen is, although the momentum is improving, these longer term averages, which is the 200-week moving average, the 89-week moving averages in the green, they will actually begin to consolidate around here, and eventually the 20-week moving average, which is the blue line, has already moved above the 89 period, and all of these will begin to move above the 200-week moving average, and we could have a really fantastic move to the upside. Now, by the looks of it, this is where we have some minor, as like a shorter term target. We can see between 36.81 and 37.66, because that's the 1.272 expansion of this range. This market had been a pretty big range since January 2023, and the bottom came in pretty much after 1 year, 22nd of January 2024, as if someone is timing all of this. And here we go. So I think it's got a chance to go and actually hit the 41 level, which is the 1.618 expansion, and I believe that's where we have the 61.8% retracement as well. There we go. So this region, in my opinion, is gonna be a target for us, but it could also be a resistance point where we could see some sort of a pullback come in this market. And of course, this market remains really strong. Now Hang Seng, let's take a look at the Hang Seng index. Here we go. This is the Hong Kong market, and I think the Chinese mainland market was closed last week because of the Golden Week holidays. So I think that's like a 1 week long holiday, and per my knowledge, based on some of my friends from China, the holidays are this long because China is a really big country, and people like to travel to go and meet their family and friends. So it takes a couple of days just to get there, and a couple of days just to come back. So that's why you need more time, and this is why the Chinese holidays are much longer. And the Chinese New Year is typically, I believe, a 2 week long holiday. And the traffic situation in bigger cities, my friends have told me around the holidays it gets really bad. So I hope whoever was traveling, they were able to get wherever they wanted to go to their destination based on their schedule. Now here, what we see is basically this market, whenever it has its decline, this was about a 66% decline during the financial crisis of 2007-8. And then this one is 2017. I don't know exactly what was going on back then, but the market, if you take the top and the bottom, which came around here, that was about a 56% retracement. So the Hong Kong market goes through pretty big cycles, as you can see. And one of the things is that it looks like what it has done is it formed a double bottom around here. And with the stimulus coming up, this market is also pretty strong. And the chances are, after breaking above the 38.2% retracement, it's right at this swing high. I think, in my opinion, it's actually targeting this 26,307 figure, which is going to be the 61.8% retracement. And I did not do the expansion of it, but just based on the FXI, because the pattern looks very similar. There you go. There you go. I think even even it has a chance to go a little bit higher. This 78.6% retracement of this swing. So the 61.8% retracement is of this swing, 78.6% of is from this swing, and looks like anywhere between 26,307 to 27,600 is where this market is most likely heading, based on the pattern formation that I can see. Let's also take a look at the emerging markets. The emerging markets are also getting stronger after a big decline that you can see here. And what we can see is basically, if we were to draw a trend line like this, so it's been forming higher bottoms all along, and higher highs there, but these swings are really big, and I can see a bigger ABCD around here where probably this leg is getting a little bit extended, the CD leg. So I mean, it's not an easy market by the looks of it, because it declines when they happen. They are pretty big. This is what the emerging markets is doing, and really interesting is what is happening in Europe. So let's take a look at the German market, the German DAX. Now, German DAX is also approaching its big ABCD from the bottom of March of 2020, and that comes around roughly, we can say 20,000 mark, but it's around 19,900. Let me mark it like this. So roughly we can say 20,000 perhaps, and then if we just move to the daily chart, here we go. Look, this market really strong rebound from the 5th of August lows, and that's where we have this big 38.2% retracement exactly to this point. And the pattern formation that I'm looking at is in this shaded region, and the chances are it could actually hit that 20,000 mark there, and that will be the 1.618 expansion of these highs coming in from the 16th of May 2024 to the 5th of August 2024. So really interesting. We have like two different patterns from two different time frames: weekly, the really longer term one, and the daily, the shorter term one. They are kind of coming up in a region, forming a confluence level, and that's why we should really pay very close attention to the levels of 19,900 to 20,000 in the German DAX, because that's our target, but it could also turn out to be a pretty strong resistance level, and we could see a pretty healthy pullback from there. Just like, if the long-term subscribers will know that we were pointing out this 1.272 expansion, and it was really a smaller swing of this one, but it led to such a big decline here, and for the number of months it went into this, it was over 2 months. So this one could be even bigger. Now let's take a look at what is happening across the pond in the United Kingdom. I think I have chosen the wrong one. This is the one we were looking at. Yeah, this is the one. And you can see it's just after forming this bottom of 5th of August, it's just gone nowhere. It's in a really frustrating trading range behavior at this UK market. And one thing could be that the British pound has actually been pretty strong. And also FTSE is a kind of a index. If you just FTSE 100, if you look inside it, there are a lot of miners in it. So the miners actually go through a lot of cycles, and of course the dollar impacts those underlying metals as well. And recently after Brexit, there have been a number of companies who's actually been delisting from FTSE 100. So yeah, you can see just a trading range behavior here. I thought it had a chance to still go and make about 8600 to 8650. That's where this big ABCD is. Maybe it's still able to do that, but right now it's just in a really ugly looking price action is what it is doing right now. Okay, now let's begin to take a look at how the US markets did. Okay, so with that, let's take a look at the S&P 500 cash market. And here we go. So this is the close of last Friday. And the really interesting thing is that how the bond markets and the stock market, they did totally opposite things, because with the unemployment rate being a little bit higher than expected, um, because the expectation per the data was 4.2, I believe. Let's just go back. 4.2 came in a little bit stronger, 4.1, and much stronger on non-farm payroll data. But the stock market liked it, because this shows that the US economy is strong. So it's no longer that case where the bad news was good news. It means that the market is basing off strong fundamentals that on the economic front. So here it is slowly but surely moving towards our targets. And on the cash market, we are looking at about 58.15. Anywhere between 58.15 to about 6,000 is the kind of where this market will go. If the bigger ABCD is completing around 6,100, it's easier to see it on the weekly chart. Here we go. So we'll just have a there we go. So you can see this black big ABCD 6110. It's possible that the market could actually get there. Now, if we just have a look on the S&P 500 futures, so the futures, on the weekly close, perhaps not as strong as the cash market. That's pretty interesting. And I think it has the chance. This is the ABCD equivalent to the cash market that we're looking at. Now, if we take a look at the cash market of NASDAQ 100, it's just being stopped right here by the 78.6% retracement. So I think it's easier to view it on the futures chart. So there we go. It has completed this bigger ABCD. Other markets are catching up. But this 78.6% retracement, a couple of weeks, is kind of hanging in there. And last week's price action. Now this is like from a candlestick perspective, it is a hanging man formation. I don't pay much close attention to hanging man formations, to be very honest. There are only very few candlestick patterns that I look at. What is really important is that what the follow through for next week is going to be like, because you can argue this one was also some sort of a formation of a hanging man, but here what is important is it was a narrow trading range week. And in this week, on 8th of July, this one had a pretty big wick, and then it also had a lower wick. So here there was kind of a fight between the buyers and sellers, and there was just no real conclusion in the end. And here you can see we have like hanging man kind of a formation or variation of it, or a spinning top, but there was just no follow through, and then we had a really good looking bullish candle. So here I would just wait and see what sort of follow through we get, whether it will actually take out last week's lows to the downside. Then the pressure might build to the downside. But here what is important for us is it is a pretty frustrating trading range behavior on the weekly chart, being capped by the 78.6% retracement, and the chances are that we might just remain in a trading range behavior for the next few weeks as well, till our cycle dates, which we saw on the daily chart for Dow Jones. Those begin to hit from a time perspective. Now let's take a look at the YM, which is Dow Jones. And here you go. Dow Jones was also it is something which we discussed before. Looks like it wants to go or creeping higher towards 44,000, or right towards in this box. It might be able to in fact complete its bigger ABCD. We'll have to wait and see what's gonna do. But trading range behavior again past week, pretty much similar to what we saw in the NASDAQ futures, but of course a little bit different pattern, because it is not being capped by 78.6% retracement. It remains pretty strong, in fact, because of being above the 1.618 expansion of this BC swing. So maybe slowly but surely it could actually creep higher, as well as the S&P 500 also begins to move higher. And while we are at it, let's also take a look at the NYA, which is New York Stock Exchange index. This also includes ADRs. I believe it's got about 2,000 stocks in it. And it's got a formation which is very similar to the Dow Jones. And it looks like it wants to go and hit the 19,980 mark, which is the 1.618 expansion of this entire bear market, which took place in 2022. Okay, now Russell 2000 from the futures perspective. Let's see what it did last week. Yeah, so I think this is where the small caps are struggling a little bit. I think they're likely to struggle for some time, especially, let me move down to the daily chart. Here we go. So on the daily chart, last Friday, actually, they tried to do a little bit better. And something really interesting that I have spotted, I'm not sure if it is complete yet, but it looks to be quite close. And that's this ABCD. And it missed the exact bottom, about 2180, about 7.78 points is missed it by. So if there is just no follow through the downside, we might have seen, the ABCD kind of a bottom come in. I believe it's the 38.2% retracement from here. If it is, yeah, it's close to 50% actually. That's pretty strong as well. And it might be 38.2% from here. So what we'll actually essentially will have is basically a pattern of higher lows. But if you look in overall context, it's just a trading range. It just goes to the top of the trading range, then sellers come in, and it just remains a range bound. It's just small caps. I think if the yields begin to move lower again, that should help the small caps more, and we could see finally it getting maybe perhaps 2358. We'll have to wait and see. But right here, I'm paying attention to this possible completion of ABCD, or maybe it's a near about completion of this one. And then if it holds, then that's gonna be a pretty good bullish sign for this small index. Now let's also take a look at this on the cash side of things. So that's IWM, slightly different kind of a pattern formation, but this ABCD is also visible here. So it got to the boundary of this. I look at this as a gap, and I'll show you why it is a gap per my analysis. Here we go. Yep. So in fact, on the cash market, it has done ABCD. I would like to think that this is the 3rd of October is a pretty good low, and the chances are this market is actually heading range from a trading range behavior to higher, not to the downside, unless 2015 is broken to the downside. So in fact, that last Thursday might have been a pretty good bottom coming in this market. So that's really interesting to see. And we can also do the expansion of this one. So I think let me actually show it to you. Here you go. Yeah, there we go. It came between the 1.27 to 1.618 expansion, but closed right at the 1.272 expansion. That's a sign that we have a confluence of two ratios coming together. That's good. So let me actually move this box a little bit higher. So here you see how this candle was. There was at one point a lot of activity here, but that might not be actually true, because here, when right at the top, there might have been just someone, or just who's offering maybe one contract or one share to be sold, whoever it was, and he might be offering there. And because of the auction process of bid and offer, somebody might have bid, and they offered right here, they accepted their offer, boom, and it just went there, filled it, but it closed right here. So that might be just kind of a market moving in a vacuum, or sort of a gap formation. This is why I look at these when we have a candle formation like this as a gap formation. And this is why a lot of times the markets actually come back and come right into to fill this gap, which I call a gap. And here the interesting thing is, the market could actually come right towards the lower boundary of it, midpoint, or completely actually go towards the top part of it, so completely fill the gap. Different markets will behave differently. Usually in the futures, because the futures are open the more than the regular trading hours, you often see the gaps being filled to the midpoint and even a little bit higher. Now another thing, let me actually show it to you. If we were to just look at it from a pure price action perspective, I think we are digressing into something else, but just wanted to really show you this one. So here I would have actually also looked at this as a gap formation right here, this and this, so top of this one and the top of this candle right here, and we had a retracement where the market went into it, and in fact this time actually went above it but closed below. So yeah, not all the gaps like this, and there will be some really key ones which will just come out to you, so you'll be able to spot them, but not always all of them will work like this. But mostly in the futures market it happens a lot more than the cash market, in just my observation. So I think we have covered quite a lot of things. Now we can just move towards some of the sectors. So let's take a look at the energy. So the energy sector has performed much better. I think that might have to do with the geopolitical tensions that we have been looking at, which is all over in the news, so I don't want to go into the details of it, but you can see that we were watching for this 1, 2, 3 drives pattern, and what we have seen basically a pretty strong move, but essentially it's right towards the top of this trading range. So in my opinion, it's still a trading range, and let's see if we are completing some sort of an ABCD pattern. Here we go. And there we go. So yeah, well, let's see what sort of follow through we get tomorrow. If the low of this candle is taken out to the downside, so last Friday's, I think it can move back into this trading range, maybe come back test this at least the middle part of it. Now let's take a look at the financials. I think I'll do a video on it, so I will not touch it. XLK, we had a look at in yesterday's video. Healthcare. So the healthcare has been declining for some reason. I'm not really sure why, but it also looks like, just from a trend, really simple trend line, it's approaching that. So maybe that might just act as a fulcrum, and there might be a little bit of a move to the downside on the weekly chart. Let's see if we were following this on the weekly chart. And here we go. Okay, now I know why it's coming down, because it hit its 1.618 expansion. So let's just wait and see. The chances are it might actually move a little bit lower by about $1.50, right towards 20-week moving average, which is in blue. So we'll wait and see what it's going to do. Right here, there's some structural support coming up as well. Let's take a look at now the consumer discretionary. So this is a really interesting one, because the consumer discretionary has actually gone and completed our pattern, this ABCD that we have been watching for quite some time actually. And now let's see what we have actually now seen as of last week is basically a trading range that took place right here. But I would like to see further confirmation, and the confirmation in my opinion will come from a follow through, and especially if the lows of 30th of September are taken out to the downside. And what it could mean is it might just come back and pull back right towards the bottom of this channel in this consumer discretionary. But this pattern, it is a pretty strong resistance level, because we have this completed ABCD right at the 78.6% retracement, and I'm not even done the expansion of this BC swing. So this is like a number of things coming together in a confluence. So it could be a pretty strong level to watch. And on the flip side, if it breaks out of it really strongly, this means the market is really strong. That is going higher towards this 240 mark. And on the daily chart, here we go. And now this is really interesting. Why it is interesting from my perspective, because we had the yields go up on pretty much all throughout the yield curves tenors. But the consumer discretionary last Friday closed higher. So that's really interesting. This means that maybe what the treasuries have done is more of a new knee-jerk reaction, and over time the yields are likely to come lower, and that is also my opinion. And now let's take a look at the utilities. So utilities have been really strong. We have been discussing this. So now it's heading towards 84.50, possibly even 92.51. That's going to be the expansion of this 2022 bear market. I have not drawn a ABCD of it, but we could easily do that. This is like the COVID lows, boom, and boom. So yeah, I think anywhere between 89 to 92, 92.50 is kind of the region to be. We should be watching as potential targets the market wants to go, perhaps. Then we look at the industrials. So industrials were strong and they are still strong. On the weekly chart, they keep on creeping up. I think they want to go 141. Then let's take a look at the materials sector. So there's some weakness came in the materials sector. So let's just keep on watching if we get a follow through. So it's an inside week which happened inside this big bullish bar. Sometimes when we see really strong moves like this one, like the week of 23rd of September, at times they are like an exhaustion move as well, and then the market actually flips over. We have seen something like this here, and then the market just went trading range, and boom, that was the strong move to the downside, and the market just started to move lower. Here's another example here, and there was just no follow through. So whether we get into a situation like this because of the inside bar, we are not sure. But if it breaks below the weekly low of 23rd of September, which is weak, then I think it's coming back into this range. Now let's take a look at the real estate. The real estate. Okay, so yeah, this is what we were watching. Remember when we were looking at this pattern formation here, we had a pretty strong resistance coming right here. This is the kind of situation which we have in the utilities as well. And what's the utilities that we had a look at? I can't remember, sorry, but we had a pattern like this. So this is a pretty strong resistance because of this pattern. So right at the 61.8% retracement. It's an ABCD right here. Some people have gone and given it a specific name as well to this pattern, but I'm not gonna call what the name is, because I think what is more important is the ratios and the one-to-one price projections. That's rather than some sort of a name. I can give it my own pet name. So here we have seen for 3 consecutive weeks the market has been pulling lower, and I believe it's back off the back of expectation of the yields moving higher, or the Federal Reserve doing not as big of an interest rate cut. Those could be the fundamental reasons. Technically, it's at the resistance level, and this is what I had mentioned based on this pattern formation. If we just quickly take a look at on the daily chart, what we can see is that last Friday we have this kind of a candle formation, where the buyers actually moved it lower, and then the sellers moved it lower, and the buyers came in and pushed it higher. So let's see what sort of follow through we get. If we get some sort of follow through like this, which is an island reversal, is one of the stronger patterns that I really like to follow and watch, because they usually mark. If they happen at the top, then it is usually a pretty important top that has taken place. When they happen at the bottom, it is usually a pretty important bottom. But the way it needs to form is there needs to be a pretty good gap formation between these two, just the way it happened here, and the market just kept on moving higher. So a similar kind of pattern can happen if it moves, if it opens with a gap higher and it closes higher, then that's going to be an island reversal, and that's going to be really good, for the index. Now let's take a look at XRT, which is the Spider S&P retail index, and you can see that it's just gone nowhere. This 50% is like a retrace half of 50% of this one, and to me it looks quite similar to, at one point, this is how the pattern formation was for the Russell 2000. So it's just gone nowhere, and with the holiday season coming up pretty soon, let's see if it breaks out. We'll have to wait and see what's going to do. And the really interesting thing is, if we were to look at Costco, on weekly charts for about 3 consecutive weeks. It's also pulling back, which is kind of interesting to watch, because Costco has been, a relentless rally in Costco for a long time. So this is what we are watching in different stock indices at a global level. So what's happening in China, Hong Kong, emerging markets, in the United States, Europe, and we also looked at some of the sectors. So I think we covered quite a few things. So thank you very much for watching the video. If you found this video of educational value, give it a thumbs up. And if you like our kind of technical analysis, please do subscribe to the channel. And if you do, then hit that bell icon button. That way you will know when the new videos are posted, so you'll not miss on anything. So thank you very much for watching the video. Good luck, good trading, and I'll speak to you guys soon.